You look at the central bank balance sheets exploding right now, and you say there's going to be inflation.
Again, this falls into the category of not confidence building for the Fed as they try to decide when they want to get to cutting interest rates.
The Fed's just admitted to failing at bringing down inflation to the planned target. How long can your wallet take the relentless grip of high interest rates? As the Federal Reserve clings to a staggering 2-decade peak rate of approximately 5.3%, millions of Americans find themselves on the edge of financial uncertainty. In a move that sent a shock across the nation, the Fed has once again decided to hold interest rates steady, a decision underscored by the persistent haze of inflation that refuses to clear. Despite several recent reports suggesting a potential easing, the reality presents a bleak contrast, leaving many to question, when will relief come? This episode gets into the Federal Reserve's latest stand, a stand that could shape the economic landscape for months, if not years to come. Join us as we unpack the implications of this monumental decision and what it means for your financial future. The economy is growing, but the price hikes are getting even higher. Recently, the Federal Reserve announced that they're keeping the main interest rate at about 5.3%. Many of us were hoping for some relief, but instead, we got news that suggests things are more complicated than they seem. Last month, we saw reports that prices are rising faster than many expected. This isn't just numbers on a paper. It means everything from our groceries to gas is getting pricier. Economic growth is usually good news because it means more jobs and better wages. However, it also means higher prices can stick around, making it tough for people to manage their budgets. The Fed's decision reflects their worry that inflation hasn't slowed down enough. Jerome Powell, the Fed's chair, recently mentioned that despite the challenges, they are still aiming to get inflation back down to 2%. But he admitted it's probably going to take longer than they thought. Initially, there was a bit of excitement in the stock market because Powell said they weren't planning to raise rates even higher to fight inflation. He seemed pretty sure that the next move wouldn't be to increase the rates. This news gave people a bit of hope. However, that hope didn't last long. By the end of the day, stock prices went back to where they started, showing that investors are still nervous. It's like everyone's watching and waiting, unsure about what will happen next. This whole situation shows just how tricky it can be to balance things out. On one hand, we've got solid job growth and businesses doing well. On the other, high prices are making life tough for a lot of people. The Federal Reserve's job is to manage these ups and downs, but right now, it's clear they're finding it as tough as we are to predict what's next. What does it really mean when the Fed decides to keep interest rates high? For starters, it affects anyone looking to borrow money. High interest rates mean higher costs for taking out loans, whether you're buying a house, getting a car, or just swiping your credit card. It can make monthly payments more expensive, which tightens everyone's budget. But it's not just about loans. High interest rates can cool down spending. When borrowing is more expensive, people and businesses might think twice before spending. This can slow down economic growth a bit, which is exactly what the Fed wants to avoid inflation from spiraling out of control. However, it's a delicate balance. Too much cooling off can lead to a slowdown in the economy, and nobody wants that. For the housing market, the impact is direct. Higher mortgage rates can slow down home buying. This might cool off overheated housing prices a bit, but it also means some people might get pushed out of the market because they can't afford the higher rates. This has a ripple effect. Fewer home sales can impact a lot of jobs and industries connected to home buying, from construction to home furnishing. Investors in stock markets also feel the heat from high interest rates. Generally, when rates go up, stock prices might drop. Why? Because higher rates can lower profits for companies, making them less attractive to investors. Plus, safer investments like bonds might start looking more appealing because they offer better returns with these higher rates. Another key area affected is savings. High interest rates can be good news if you've got money in the bank. Savings accounts, CDs, and other deposits might start offering higher returns. So, for savers, this could be a good time. But let's talk about everyday prices. Everything from your diner breakfast to healthcare. High interest rates don't immediately lower prices. In fact, businesses facing higher borrowing costs might pass on these costs to customers. So, while the Fed is trying to tame inflation, we might not feel the relief at the checkout just yet. Overall, the Fed's decision to keep interest rates high is like trying to balance on a tightrope. They're trying to slow down inflation without tipping us into a recession. It's a tough job, and the outcomes are uncertain. We'll all be watching closely to see how this plays out in the coming months, affecting everything from our personal finances to the broader economy. So, why does the Federal Reserve's decision on interest rates matter so much to us? Let's break it down a bit. The Federal Reserve, or the Fed, is like the central bank of the United States. Its job is to manage our country's money supply and interest rates to keep our economy stable. One of its biggest tools is the power to set interest rates. These rates affect how much it costs to borrow money, whether it's for buying a house, starting a business, or just using a credit card. Back in the day, the Fed's key interest rate was a lot lower to help the economy recover from big setbacks like the 2008 financial crisis. But now, the situation is different. We've been seeing prices go up across the board, from your morning coffee to your monthly rent. This is what we call inflation. When prices rise, it generally means the value of money is going down because you can buy less with the same amount of money. Here's why the Fed's recent decision is particularly important. By keeping interest rates high, the Fed is trying to slow down how fast prices are rising. It's a bit like tapping the brakes on a car that's speeding too fast. The idea is to prevent the economy from overheating. If prices rise too quickly, it can lead to big problems, like people not being able to afford basic needs. The decision to keep interest rates high is a signal that the Fed is still worried about inflation staying stubbornly high. Even though some parts of the economy, like job growth and consumer spending, are doing pretty well, high inflation can wipe out those gains. Essentially, the Fed is being cautious, holding off on cutting rates until they see more signs that price increases are really starting to cool off and stabilize at a lower level. This approach is meant to ensure that our economy grows in a healthy, sustainable way without letting inflation get out of hand. Now, let's talk about the bigger picture, how all this shakes up in the political arena. High interest rates and stubborn inflation are more than just economic terms. They're major issues that can influence elections. With President Joe Biden gearing up for a possible re-election bid, the state of the economy could play a huge role in whether voters feel confident keeping him in office. For many folks, it comes down to their wallets. When people feel the pinch of high prices and expensive loans, they start looking for answers, and sometimes for someone to blame. This puts extra pressure on current leaders to show they're handling the situation well. If voters feel like their financial struggles aren't being addressed, they might call for change at the polls. The timing is tricky too. With the election just around the corner, every economic move is under the microscope. The Federal Reserve, while independent, can't ignore the political climate. Their decisions can either give a boost to the current administration if things go well, or add fuel to the opposition's fire if the economy sputters. This year, as inflation has stayed high longer than many expected, there's a lot of chatter about whether the Fed's strategies are working. People are debating whether keeping rates high is the right move, or if it's time to try something different. These debates aren't just happening in financial circles. They're a topic of conversation at dinner tables and in coffee shops across the country. And let's not forget the global scene. The US economy doesn't operate in a vacuum. How we handle our financial policy can send ripples across the world. This not only affects international markets, but also plays into foreign policy and our standing on the world stage. Leaders from other countries watch our economic health closely, as it impacts trade, investment, and even security policies. In essence, the Fed's interest rate decisions are more than economic tools. They're also political signals. They help shape the narrative about how well the country is being managed and what kind of future voters can expect. As we move closer to the election, every economic indicator, every rate decision, will be parsed for its political implications, making it a critical time for both policymakers and voters. As we look ahead, what can we expect from the Federal Reserve? Jerome Powell and his team have laid out several scenarios that could influence their next moves. These aren't just guesses, they're based on real data and trends that they're watching closely. First off, if the job market stays strong and inflation doesn't make any significant downward strides, basically, if prices keep moving sideways, it might make sense for the Fed to hold off on any rate cuts. They're saying, if things don't get better with prices, we can't risk making borrowing any cheaper and possibly making inflation worse. It's a cautious approach, making sure they don't add fuel to the fire. However, there's another side to this. If we start seeing inflation cooling down more noticeably, or if unexpectedly more people start losing their jobs, the Fed might feel more comfortable lowering rates. Lower rates would make it easier for people and businesses to borrow money, which could help boost spending and get the economy humming again. This could be a relief for anyone looking to finance big purchases or expand their businesses. Jerome Powell has also shared a bit of optimism. Despite the setbacks, he believes that by the end of this year, inflation could start to dip back down. This isn't just hopeful thinking. It's based on trends they've observed, like improvements in supply chains and some prices starting to fall. But again, the Fed's message is clear. They need more solid evidence that inflation is truly on a downward path before they make any moves to cut rates. Another critical aspect to consider is the Fed's bond buying program. They've been buying huge amounts of government bonds to help keep long-term interest rates low. A policy started back when the economy needed a massive boost. Now, they're slowly backing off, letting these bonds mature without buying new ones, which is another way they're trying to keep inflation in check without hiking rates further. All these actions show the Fed's balancing act. They're trying to steer the economy through uncertain waters, ready to adjust the sails as needed. It's a complex task, and the decisions they make have a ripple effect, impacting everything from Wall Street to Main Street. As we continue through the year, it'll be crucial to watch how these policies unfold and what they mean for our economic outlook. Whether you're a saver, spender, investor, or just someone trying to make ends meet, the Fed's policies in the coming months will be something to keep a close eye on. It's not just about the numbers, it's about how these policies will shape our economic future and our daily lives. As we continue to navigate these uncertain times, staying informed and understanding the impact of these decisions is more important than ever. Hit that subscribe button and turn on notifications to never miss an update from us.